Hi, this is Michael Kolb, CFP and Portfolio Manager with Evergreen Wealth Solutions, here with your July 2023 market. Starting with stocks. Equity markets really rallied in July. Rising investor confidence really helped support the stock market at the second half of the year. The S&P rose by 3.2, the Dow by 3.4, and the tech-heavy NASDAQ actually led the way with an over 4% rise. These brought all three indices to near their all-time respective highs. So while the actual stock prices rose, the actual fundamentals showed us signs of a slowdown. As of July 31st, with a little more than half of the companies reporting, there was actually a decline in the S&P 500 earnings by over 9%. This weakness was mostly concentrated in energy and materials, but there was also a larger than expected decline in healthcare earnings. And while much of this was anticipated, it was unexpected for the healthcare sector. So unlike the fundamental factors, the technical factors were actually very supportive of all three major indices, finishing well above their 200-month moving averages. And this was actually the seventh consecutive month of that happening. International markets were also a very similar story in July, very, very strong, gaining 3.2%, as well as the emerging markets index surging about 6.3%, with strong technical factors as well. Now, taking a look at bonds, it was the opposite for bonds, with rates rising on the 10-year from about 3.8 at the beginning of the month to almost 4% at the end of the month. That caused the Bloomberg Aggregate Bond Index to actually lose a little bit. Most of this came from the Federal Reserve hiking rates again by 25 basis points, which was expected by investors and economists. But the major takeaway was actually that the Fed no longer expects to see the economy enter a recession anytime in the near future. And this is a really positive revision to the Fed's outlook that suggests the central bank really is not likely to raise rates again in a September meeting and could actually maybe signal the end of the rate hiking cycle. From an economic standpoint, most of the economic updates released in July showed signs of better than expected growth across the entire economy. Second quarter GDP actually rose by 2.4% when it was expected to be 1.8%. And this growth was particularly supported by increase in improved consumer confidence and in consumer spending. Consumer sentiment measured by two major indices actually went up substantially. One of them, the Conference Board's Consumer Confidence Index, now actually sits at its highest level in 2 years. There was also very strong job creation in the first half of the year, adding another 209,000 jobs and bringing unemployment to 3.6%. But perhaps the most impressive feature of the current economic expansion is the fact that we have all these solid growth signs combined with declining inflation. Annual consumer inflation fell to 3% in June of 2023 after peaking at over 9% in June of 2022, which really highlights the progress that's been made combating inflation over the past year. So what are the risks? Well, in the first half of the year, we saw a lot of risks negatively impacting the market. We had the debt ceiling, we had the banking sector, and most of those, though, have cooled pretty notably. Looking forward, there's still a lot of risk that we need to make sure we're monitoring. Domestically, the biggest risk is probably the chance of inflation spiking again if growth continues at this rate above expectations. Internationally, we're going to still focus on both Russia and Ukraine, as well as the concerning slowdown that's happening in China. So despite all these risks that are happening in the market, the economy has been pretty strong. It has been quite the tailwind for most investors. Better than expected economic news in the start of the second half of the year continues to paint a really healthy picture of economic expansion, which hopefully will be supportive to stock prices. With many of the primary risks from earlier in the year receding, we think the outlook for the rest of the year is positive for both markets and the economy. Of course, while economic growth and market appreciation are the most likely path forward, there's potential for short-term disruptions. So a well-diversified portfolio that matches your timelines and your goals is always the best path forward. As always, if you need to reach out to your Evergreen Wealth Solutions advisor, please let us know and we can discuss your situation.